Welcome to Quickshots.
Welcome to Quickshots. Damn, we have a lot of questions this week and we really had to cut this one down. So hopefully you guys will like these ones as much as we did, because you've been very popular this week, and therefore I will be asking you the first question. We did overpromise and now we will overdeliver on the pod this week. We talked about what actually is inflation and how does it impact the average Joe?
Good question. Yeah. Sorry, I was lost
Jeff.
in. I stopped listening for a moment. So inflation, yeah, it's been everywhere. Hey, like literally, I reckon for the last week, inflation's been the headline on most newspapers every single day. Inflation is the increase in the price that we pay for goods and services. So that could be a loaf of bread, could be a carton of milk, could be petrol, fill up a tank. Could be anything. Could even be the cost of our accountant to prepare BAS statements. Who knows? It affects us in many, many different ways. The annual rate of inflation in Australia today is 2.6%, adjusted for all the extraordinaries. Put another way, if you paid $4 for a coffee last year, it should be costing you $4.10 today. That's the reality of it. Bit of context, for the past 30 years, inflation sat at about 2.3%. So, around that 2% mark. Okay. In the 70s and 80s, it was even higher. It was like double digits. So in 1975, I think, highest we've ever had, nearly 18%, which would have pushed the coffee from $4 to $4.70. There'd be outrage, I would dare say.
Tell me about it.
So why is inflation then important? Well, obviously it's important because it impacts the price we have to pay for things like loaf of bread, milk, etc. It also impacts, however, how we get paid because, and they call that wage growth, typically when we earn more, we spend more, and that creates the inflation. So you typically actually don't see inflation without wage growth at a similar, if not higher, level.
Thank goodness.
Correct. And then people like the Reserve Bank would say, well, we want, a healthy amount of inflation because it's going to see people spending money, but it's also going to grow the wealth of households and just have we've got a generally positive and forward-moving economy. They don't want it to be too high, though. So too high, too low, sort of like Goldilocks, somewhere in the middle. The reason it's in the headlines today is because they like it to be between 2 and 3%. That's where it is today, the Reserve Bank, that is. The problem, though, is that it's not being driven by wage growth. We don't have wage growth being driven by supply shortages today. So the Reserve Bank are not happy. They're saying we will not be doing anything unless we start to see some inflation because of wage growth. They think that is going to happen in the back end of the year. So we will probably be getting paid a little bit more towards the end of the year, hopefully, fingers crossed. And if that then happens and we see some inflation, then we're likely to see the Reserve Bank increase rates from a record low. The good news for us, though, is that we're probably not going to see rates increase until we get paid more, which is a good thing if you're an investor.
And honestly, makes perfect sense and never deconstructed in such a way that doesn't make us panic about interest rates increasing. So I thank you.
No problem. I'll throw this. I'll hit you with two here because I think this first one's like a little bit cheeky. It's come from Rocco. He says, with crypto going down 30% in the last 3 months, are you guys laughing?
I'm scared what the next question's going to be. Yeah, good old Rocco. He does love property, so that's okay, but he also does love crypto. Look, I cannot and will not hang it on crypto. I believe that there is undoubtedly a necessity for anonymous money, decentralized money, if you will. So it will play a big part in the future in some capacity. But also, we've got to remember, in any investment, property, shares, crypto, whatever it is, it's an investment because it's time. You invest time. Yes, of course, money, but you really need to, I guess, take a bit of a step back, not be so emotional. So yes, okay. So it's gone down 30% in a few months. Do I know much about it? Not really, but I guess I am seeing those big crypto players actually go back in and buy more because it has fallen 30%. So some people fear and some people see opportunity. But I just feel like, perhaps crypto right now it's in a bit of a vulnerable state. There's a lot of new cryptocurrencies coming on. It's pretty volatile, I suppose, because a lot of people can get into it, with $3, $4, $5 as a bit of a starter. So you've got a big sort of mix. And there seems to be a lot of speculators. So am I laughing? No, not really. But I am kind of interested in and sort of watching. Not for me, but just take a long-term view for your investment. That's all you got to do.
It also may have gone up 50% since we started recording this podcast, for all we know. It's that volatile.
That's true.
And then this next one from Steve, there seems to be better deals now on established properties as compared to new properties. Is there any reason I'd avoid established when I can potentially save up to 40 to 50,000? Apparently.
Yes, it's a very good question, and one that I honestly have asked myself many times. But when it comes back to the numbers and the de-risking, and I suppose the word I like is predictability of my investment, new build always seems the way to go. And by the way, in my portfolio of 5 properties, one of them I bought as established, and guess what? It's the one I've spent the most money trying to upkeep, and it bloody sucks. I'm not saying there aren't circumstances where an established property may be better for you. Especially if you're going to live in it or you eventually want to live in it and it is an investment just temporarily, or you want to do a big project and do a big renovation, that's totally fine. Maybe it's the only way you'll be able to get into that area. But on the side of investing where you want to be able to duplicate and I suppose de-risk your investment quite a lot, the cash flow is really where the new comes into play. Why? Because you're going to get the highest rent, the lowest maintenance, and of course, you're going to get the most tax deductions. So there's growth on new and established if you buy in the right area, but on new, you're just going to see better cash flow. I'm sure that there's many more ways I can explain and go into a bit more detail on that, but that's where I'm going to leave it today. May I finish on the last question for you, Cuz?
Go for it.
Excellent. This one came into our Instagram, so thank you, T. T read your article in realestate.com on the weekend, Cuz. Famous. Thanks for that, T. She asked, look, I can only get into the market for about 300 grand. I've been looking regional. How do I go about this?
Very good. I think first and foremost, I would say if you have a borrowing capacity of 300,000, just check that is your borrowing capacity, because the difference between 300 and 400,000 isn't a lot. I've seen a lot of people go through that process and see that it does change. And that could be the difference between getting into a capital city or not. I think always we would say there's better opportunities in the capital cities than the regions because there's more population growth. However, if you did want to get in the market or if you had a particular connection to a region, I don't think it's a bad thing. Probably better to get into the market than not be in it. But I would caveat that by saying it's really important that you get a loan that's manageable. Try not to be getting sort of a 90-95% loan in those areas because you get volatile valuations. They can go up and down. They're not as stable as the capital cities. And most importantly, you can deal with the volatility if you've got really strong rentals. So I think make sure that you've got maybe like a 5% rental yield if you're going into a region, because you're going to need that rent to come in, allow you to tread a bit of water in the periods that you don't have the valuations going up, or you might even have them going down, and you've got to just sort of wait it out and keep paying the mortgage off until the valuations rebound. That would be my personal tips on that. Alex, you got anything to add?
Oh, look, I would agree. And my first question would be, how have you determined, that you can borrow 300? Is that one bank, one broker, or I suppose, have you looked at multiple options? Have you really investigated and felt that you have done everything you can to go hard and investigate? Because, it's important to make it, it's important to get it right. So make sure you invest the time to go and figure out those things and really what you can borrow. Of course, it needs to be comfortable, but also if you have the opportunity to get into a capital city, don't let that one pass up. So I agree with you, Cuz.
All right, jam-packed today. Wow,
you really went out there. Yeah, we've smashed a lot of questions. Guys, of course, you can send your questions to us at absolutely any time. We are both on our emails, a little bit too much, if I may say. They are in the show notes, and as is our Instagram page. We really try to do a lot of, Instagramming, if you will, or having a bit of activity on there, which we should probably pick up. So we are keeping an eye on that. If you've ever got a question, send it through. And just great to have you guys on another episode of Quickshots.
See you guys.
Thanks for listening to another episode of The Double Shot with your favourite cousins, Alex and James Fitzgerald. If you've got a burning question or something we absolutely need to talk about on the pod, please write to us. Both of our emails are in the show notes. For little real estate tidbits and a little bit of banter, a lot of banter, you can follow us on the gram. Our handle is thedoubleshot.podcast. That, my friends, is thedoubleshot.podcast. Until next time, think of us when you sit back and sip your next double shot.